Two guys walked into a real estate meetup on a Saturday morning.
I want to hear you say, "Yeah, they can't stop you." Grant!
You got the power to know.
One of them bought a rental property before the weekend was over. The other one went home, made a sandwich, and watched whatever was on television. 5 years later, one of them is building wealth, and one of them is getting texts about a thermostat at 10 p.m. The crazy part? They both think they won. One of them is wrong with the kind of confidence that usually only shows up at open bar weddings and multi-level marketing presentations. A bad financial decision never announces itself. It shows up looking like a great idea, wearing khakis, with a firm handshake and a laminated chart. You feel smart for saying yes. You feel chosen. You feel like you finally figured out something other people missed. That feeling has a name. It is called being the last person to know. And it shows up at the exact same time in every story like this. Right after the handshake, right before the bill. I am Juan, and I'm going to let both of these guys make their case, run the actual numbers, and then let the numbers do what numbers do. Mike and Danny are, for the purposes of this video, financially identical human beings. Same salary, same city, same $55,000 saved. Both want to build wealth. Both think the other one is making a catastrophic mistake. Here is Mike's move. He took his $55,000 and used it as a 20% down payment on a $275,000 rental property. 3 bedrooms, decent neighborhood, 30-year mortgage at 7%. Monthly mortgage payment comes out to approximately $1,460 a month. He finds a tenant willing to pay $1,950 a month in rent. Quick subtraction, $1,950 minus $1,460. On paper, that is $490 a month in profit. Mike did not use a calculator for this math. Mike used a napkin. A specific napkin from a specific Chili's restaurant that I am convinced is the most expensive piece of paper he has ever touched. He drew a circle around $490. He drew a small crown above the circle. That crown is doing a lot of work for a man who has not finished the game yet. It is giving participation trophy energy, except the participation fee is a 30-year mortgage. He ordered a second margarita to celebrate. Mike, buddy, Danny's move is considerably less dramatic. He opened a laptop, clicked 4 buttons, set up $350 a month in automatic contributions to a total stock market index fund, closed the laptop, made a sandwich, watched whatever was on television. Danny's coworkers asked him what he was investing in. Index funds. They nodded. Someone changed the subject. Nobody bought Danny a congratulatory drink. Nobody invited Danny to a Saturday morning meetup where everyone is vibrating with suspicious enthusiasm. Danny went home, slept 8 hours, and woke up slightly wealthier than he was yesterday without doing a single thing to deserve it. This is the number one problem with index funds. They are one of the most powerful wealth-building tools ever created, and they are completely, physically impossible to brag about at a party. Mike has a story. Danny has a confirmation email. But we are not here to impress people at parties. We are here to build wealth. So let us actually run the numbers. For the first year, Mike is absolutely living the dream, and he wants everyone to know it. Rent hits his account on the first of every month like clockwork. He drives past the property on the way to work. Every single day. He says, "I own that," quietly to himself at a red light, like a man who has fully and completely arrived at life. He had business cards printed. They say his name and one word underneath. Investor. Just investor. Not investor in what? Not investor since when. Just investor. Like a warning label. The only people who hand out business cards that just say investor are people who just became investors and people who are about to ask you to become one too. Mike is the first kind, probably. Meanwhile, Danny checked his portfolio for the second time in 3 months. The number was up. He closed the app, made a coffee, had a normal morning. Now let us look at what Mike actually pocketed through year 3, because this is where the crown starts sliding off the napkin. Mike collected roughly $70,000 in rent over 3 years. Mortgage payments totaled about $52,000. That is $17,640 in gross cash flow. I can already hear Mike. Juan, see? I told you, $17,640. That is real money. At 10 p.m. on a Tuesday, Mike received a text message. The thermostat was, and I am quoting directly, Acting weird. Not broken, not on fire, not actively causing harm to anyone, just acting weird. Mike drove over. He pressed the up button twice. The thermostat was fine. The tenant was cold. Mike drove home at 11:15 p.m. The tenant texted him a thumbs up. That was the thank you. A thumbs up emoji from a grown adult. At 11:16 p.m., for a man who drove across town at 10 p.m. on a Tuesday to press a button twice,
Good job. Let's get you 10x more properties.
if landlording was a sport, that thumbs up would be the participation ribbon they hand you while everyone else goes home. He insists this was one time. Danny's phone was on Do Not Disturb. It had been on Do Not Disturb since 9 p.m. It will be on Do Not Disturb tomorrow at 9 p.m. too. Mike spent his lunch breaks eating granola bars alone in parking lots, sitting on hold with a plumbing company whose hold music was a pan flute cover of a song he could not identify, but which now lives permanently in the back of his mind, rent-free. Which is ironic. He showed up on weekends to show the vacant rental unit to prospective tenants who confirmed appointments and then texted, "Sorry, something came up, LOL," at the exact minute the showing was scheduled, as if the conflict materialized the precise moment Mike pulled into the driveway. He wrote passive-aggressive lease renewal emails, rewrote them to sound friendlier, reread the friendly version, decided it sounded weak, sent the passive-aggressive version anyway. Some things are beyond our control. Danny spent that same Saturday at a farmer's market. He bought some bread. It was a good loaf. After all real expenses, Mike's actual net cash flow over 3 years is somewhere between $2,200 and $4,500. Not $17,640, $2,200 to $4,500 over 3 full years, while managing a property on evenings and weekends, eating granola bars in parking lots, and listening to pan flute music on hold. He still hums the pan flute song sometimes. He does not realize he is doing it. We do not tell him. Danny, in the meantime, portfolio sitting at approximately $76,000. He just got back from the gym, had a sandwich after. Things are fine. 0 phone calls, 0 parking lots, 0 pan flute. Just a number on a screen that has been quietly compounding while Mike was standing in someone else's apartment pressing the up button on a thermostat at 10 p.m. on a Tuesday. Like a man who has made some choices. But before we drag Mike completely, I have to be fair. Because Mike actually got Juan's thing right. Here is Mike's case for leverage. And honestly, it is a strong one. Mike used $55,000 to control a $275,000 asset. 5 to Juan. That is leverage. His property has been appreciating roughly 3 to 4% a year. It is now worth somewhere between $295,000 and $308,000. His equity, the gap between what the house is worth and what he still owes, a significant chunk of that wealth was built using the bank's money, while he was sleeping. Danny cannot do that. Danny cannot call Vanguard and say, "I have $55,000, and I would like to control $275,000 in assets, please." Vanguard does not say, "Sure, sounds reasonable. Here you go." That is not a phone call that ends well. Real estate lets you do exactly that. Mike used the bank's money to build his wealth. That is not a bug. That is the whole feature. Leverage is real. It is powerful. It is the single biggest structural advantage real estate has over the stock market. When it works, it accelerates wealth in ways that index fund investing simply cannot match at all starting contribution. When it does not work, it is how you end up sitting in a very beige conference room across from a bankruptcy attorney who is writing things on a legal pad and trying extremely hard to keep his face completely neutral while you explain what happened. The difference between those two outcomes comes down almost entirely to what we are about to discuss next. The $490 monthly cash flow is the celebrity of real estate investing. It is on every YouTube thumbnail. It is the opening line at every Saturday morning meetup where everyone is handing out business cards that just say their name and the word investor. Most of these networking events are really just excuses to drink and party. Sometimes they are beneficial. Usually they are not. It is the number Mike texted in all caps like he had personally discovered electricity. What nobody puts on the thumbnail is everything that quietly devours that number before Mike sees a single dollar of it. Vacancy. The average rental property sits empty about 1 month per year. That is a full mortgage payment going out with 0 rent coming in. plus cleaning, repairs, listing fees, and your own time spent showing the unit to strangers who will stand inside your investment property and ask if the neighborhood is safe while standing in the neighborhood. Maintenance. 1 to 2% of property value annually. On a $275,000 house, that is $2,750 to $5,500 per year. Some years it is a $150 drain clog. Other years it is a $7,500 HVAC system that picks the single hottest week of August to give up entirely, while your tenant, who is now carbon copying their roommate on every message for reasons that are legally ambiguous but emotionally clear, needs it fixed immediately. Capital expenditures. Roofs last 20 to 25 years. Furnaces 15 to 20. Water heaters 10 to 12. These are not surprises. They are calendar appointments you forgot to write down. If you are not setting aside money every month for these, you are not running a business. You are running on optimism. Optimism does not fix a furnace in February. And then there is the risk that nobody brings up at the real estate meetup because it genuinely, visibly deflates the energy in the room. Bad tenants. Not paid rent 3 days late bad. The tenant who pays on time for 4 months, disappears for 2, and then resurfaces with an attorney's number already saved in their contacts and a more detailed understanding of your state's eviction timeline than you have, because they have been through this before and you have not. And they know it. Eviction takes 3 to 6 months minimum. During that entire window, you are paying the mortgage, paying legal fees, and receiving zero rent. The $490 profit has not just stopped, it has been replaced by a monthly loss with no confirmed end date. Mike will tell you that is a worst-case scenario, that it does not happen to everyone. Danny will quietly point out that it happened to Mike. Mike does not want to talk about that. Mike, remember when I told you to put the napkin down? This is why. By year 5, Mike's rental property has become a full second personality living inside his life rent-free, which, given the circumstances, is genuinely funny. He is on his 3rd tenant. The first Juan left on good terms, a rare and beautiful experience that Mike will spend the next several years trying to recreate. The second Juan left owing 2 months of rent, and in what will one day be studied as a very specific and targeted act of symbolic protest, unscrewed and removed every single cabinet door in the kitchen. Not the cabinets, not the appliances, just the doors. All of them. Gone. To this day, nobody knows where they went. Mike checked the dumpster. He checked the garage. He checked the neighbor's yard for reasons he could not explain. The doors are out there somewhere, living their own lives. He called me. There was a long pause. Then he said, "They took the doors, Juan, but they left the screws." I did not have anything useful to say. Some sentences just need to sit there. Mike hosted showings for prospective tenants who wanted to renegotiate the rent, the lease terms, the pet policy, and in Juan's genuinely memorable case, the paint color. The applicant wanted moody terracotta. Mike said no. Mike repainted the wall, moody terracotta, 3 months later. It actually looked great. He is not proud of that. He has a photo of it on his phone in a folder called MISC, which is where you put things you are not ready to explain but cannot bring yourself to delete. Danny's Year 5 update. Portfolio between $130,000 and $145,000. Increased his contribution to $350 a month. The compound growth is starting to accelerate. The gains on his gains are now generating more new wealth than his contributions are. He did not replace any roofs. He has no opinions about terracotta. His phone is on Do Not Disturb. It is a regular Saturday. Year 10. Let us put real numbers on the scoreboard. Mike's property is now worth approximately $375,000 to $390,000, assuming 3 to 4% annual appreciation. His remaining mortgage balance sits at around $183,000. His equity, the number that actually matters, is approximately $192,000 to $207,000. After 10 years of mortgage interest, property taxes, insurance, repairs, vacancy, capital expenditures, 1 full roof replacement, 1 plumber who had to come back the next day, and the unquantifiable psychological cost of the cabinet door situation, Mike is out an additional $25,000 to $40,000 beyond his original down payment. Danny's portfolio, at 8% average annual return with consistent $350 a month in contributions, is sitting at approximately $165,000 to $180,000. He put in $55,000 up front, plus $42,000 in contributions over 10 years. The rest is pure compounding. He did not earn it, he waited for it, patiently, with snacks. At year 10, Mike's net position, including equity, is ahead. But here is what never makes it onto the napkin. Mike worked for every single dollar of it. Danny waited for every single dollar of it. Mike concentrated everything into one asset, in one zip code, dependent on one tenant at a time, financed by one very large mortgage, and maintained by one increasingly tired man who now has strong opinions about plumbers that he did not have 10 years ago. Danny is diversified across thousands of companies in every sector of the global economy. If one of them collapses tomorrow, his portfolio barely flinches. Year 20. This is where the story separates completely, and the full picture finally comes into focus. Mike's property is worth approximately $530,000 to $570,000. His mortgage is either paid off or nearly there. His equity sits somewhere between $480,000 and $530,000. After 20 years of maintenance, repairs, tenant turnover, property taxes, insurance, at least one major renovation he did not budget for, and one tenant whose name we will not say, but who knows what they did and where those cabinet doors went, his total net cash flow profit above what he spent is somewhere between $50,000 and $90,000. Mike is worth somewhere between $480,000 and $530,000. He built every dollar of it himself, with his own time, his own stress, and a relationship with the home improvement aisle at Home Depot that he never asked for and cannot escape. Danny's portfolio, at 8% average annual return with $350 a month in contributions, has grown to approximately $415,000 to $445,000. Total contributions over 20 years were $139,000. The remaining roughly $290,000 is pure compounding. No debt, no tenants, no calls about thermostats acting weird, no cabinet door situations, no moody terracotta. And Danny will quickly add that if he had increased his monthly contribution by just $150 more, bringing it to $500 a month, he would be sitting closer to $520,000 to $550,000. He did not replace a single roof to get there. After 20 years of completely different journeys, completely different stress levels, and completely different relationships with licensed tradespeople, both Mike and Danny are sitting somewhere between 6 and maybe 7 figures in net worth. The method was different, the gray hairs were different, the destination, 6, maybe 7. And of course, Mike already wants one more property. Just one more. That is all he is saying. That is what Mike said 5 years ago. This time, he means it. Mike, I am genuinely begging you. Before the real lesson, both of these men deserve credit where it is due. For Mike, real estate wins in specific situations. If your market has strong rent-to-price ratios, meaning monthly rent is at least 0.8 to 1% of the purchase price, the cash flow math works from day one. If you treat it like a real business and not a side hustle, screening tenants carefully, budgeting for every expense, building actual systems, the returns can meaningfully exceed the stock market, especially with leverage amplifying your gains. If you house hack, meaning you live in one unit and rent the others, you can reduce your own housing costs to near zero while building equity simultaneously. That is something index funds simply cannot do. Vanguard is not going to pay half your mortgage. That feature does not exist. And if you understand 1031 exchanges, which let you roll profits from one property into another without triggering capital gains tax immediately, you can build a real estate portfolio in a tax-advantaged way that stock investors simply cannot replicate outside of retirement accounts. Real estate is not a bad investment. It is a misunderstood one. For Danny, the stock market has real risks that your sandwich routine does not fully prepare you for. In 2008, the market dropped 37%. In March of 2020, it dropped 34% in a single month. If Danny had $150,000 in his portfolio and watched it become $95,000 in a matter of weeks, that is not a number on a screen having a bad day. That is Danny sitting at his kitchen table at midnight with cold coffee, reconsidering decisions he made years ago, including some that have nothing to do with investing. And most regular investors do the worst possible thing in that moment. They sell at the bottom and buy back in after the recovery. They trained for the marathon and quit at mile 25 when the finish line was visible. Real estate and index funds are both legitimate wealth building strategies. They are just different shapes of suffering. One calls you at 10 p.m. and always needs something. The other drops 34% on a Tuesday and you just have to sit there, like watching someone parallel park badly when you are not allowed to say anything. Both hurt. One just lets you sleep. There is also no cash flow. Index funds do not send you a monthly check. Dividends on a total market fund run about 1.5 to 2% annually. On $150,000, that is roughly $200 a month. That is a car payment. That is not financial freedom. That is a car payment. And there is no leverage equivalent. Danny used $55,000 to control $55,000. Mike used $55,000 to control $275,000. That multiplier is the number one reason real estate has created more millionaires than the stock market in survey after survey. Danny understands all of that. He also has not received a single call about a thermostat in 20 years. Mike says he has gotten much better about the thermostat calls. Danny says Mike called him last month about a thermostat. Mike says that one was actually broken, though. It was not actually broken. We pressed the up button. It was fine. Here is what this whole debate actually comes down to. Mike and Danny both made reasonable decisions with the information they had. Mike believed real estate was the proven path because someone confident told him so at a Saturday morning meetup while handing him a business card. Confident people handing out business cards that just say investor at 9 a.m. on a Saturday are surprisingly persuasive. Danny believed index funds would handle everything because the internet said set it and forget it, which is true, and also leaves out approximately everything we just spent the last 18 minutes discussing. Neither of them sat down and mapped out what their choice would actually cost in dollars, in hours, in stress, and in risk over 20 full years. And that is the number one mistake people make. Picking any investment based on a YouTube thumbnail, a podcast soundbite, a business card that says only the word investor, or something someone said confidently at a Saturday morning meetup without ever running the full numbers for their specific situation, their specific market, their specific risk tolerance, and their honest answer to the question of whether they actually want to be a landlord or whether they just like the idea of being a landlord. Those are two very different things that feel completely identical until 10 p.m. on a Tuesday when a thermostat starts acting weird. The next time someone tells you real estate always wins or the stock market always wins, ask them one question. Did you include everything? Because the answer that includes everything is the only answer that matters. The napkin is still out there somewhere, probably in Mike's car, possibly framed. I would not rule out framed. The crown is still on it, though. Nobody can take that from him. And as for Mike, he says next time he is using a spreadsheet, I will send him Juan.